Ladies and gentlemen, Asian guy here. Stop what you're doing. Put down your phone and listen very carefully because something just happened in Tokyo that is going to rip through global markets like a chainsaw through paper. While you were sleeping, while Wall Street was closed, while the world was distracted, Japan made a move. This single decision made by bureaucrats at the Bank of Japan has just armed a financial time bomb with a $4 trillion payload. The fuse is lit, the countdown has started, and almost nobody is talking about it. Here is what happened. The Bank of Japan released a quiet policy adjustment buried in technical language that most people will never read. They adjusted their yield curve control parameters. They signaled tolerance for higher interest rates. To the casual observer, this sounds boring. This sounds like central bank housekeeping. But to anyone who understands the plumbing of the global financial system, this is the sound of a dam cracking. Because Japan isn't just another country. Japan is the lender of last resort to the entire planet. For 15 years, Japan has been the source of the cheapest money in human history. Zero interest rates, weak yen, stable currency policy. And this created the most profitable, most dangerous trade in modern finance, the yen carry trade. Here's how it works. You're a hedge fund. You borrow yen at 0%, billions of yen. You don't borrow it to spend in Japan. You convert it to dollars. Then you invest in anything that pays more than zero. US Treasuries at 4%, emerging market debt at 7%, stocks, real estate, commodities. You pocket the difference. It's free money, a money printing machine. It works perfectly as long as one condition holds. The yen must stay weak. But if the yen strengthens, if it appreciates against the dollar, your trade implodes. When you have to pay back your yen loan, you need more dollars to buy the yen. Your profit becomes a loss. And if the loss is big enough, you get margin called. You get liquidated. You blow up. The global yen carry trade is $4 trillion. That is more than Germany's GDP, more than Apple and Microsoft combined. All of it built on the assumption that Japan will never raise rates, that Japan will remain the world's ATM forever. The Bank of Japan just violated that assumption. They fired a warning shot. And the smart money is looking at their risk models and realizing something terrifying. If Japan continues down this path, the entire structure collapses. $4 trillion unwinds. And when $4 trillion of leveraged bets unwind at the same time, it doesn't look like a correction. It looks like a meteor strike. Why now? The yen collapsed from 110 to 161 over 2 years, 30% loss. Japanese citizens suffering, import costs exploding. The Bank of Japan tolerated it because weak yen helped exporters. Then something broke. The yen hit a 30-year low when the government made noise. Finance ministry issued warnings. Intelligence says Japan spent $60 billion buying yen in 10 days. That's a war. Japan drew a line at 160. They won't let it hit 170 or 180. They're capping the carry trade. This creates a trap. If you borrowed yen at 150, planning to pay it back at 170, and Japan holds 160, you're underwater. You have to cover. When you buy yen to close your position, you push the yen higher. This forces the next guy to cover. It's a short squeeze in the world's third largest currency, a liquidation cascade. And it has already started. USD JPY dropped 3 handles in 30 minutes overnight. That is an earthquake. Volatility doubled. The market smells blood. The algorithms are detecting that the carry trade, the foundation of global liquidity for 15 years, is under attack. Here's where it gets truly dangerous. The carry trade isn't sitting in cash. It's leveraged into every asset class on Earth. Let me show you the contagion chain, how a crack in Tokyo becomes a crater in New York. Hedge funds that borrowed yen start getting margin calls. Their prime brokers, Goldman Sachs, Morgan Stanley, they look at the positions. They see the yen strengthening. They see unrealized losses growing. They demand more collateral. The hedge fund doesn't have cash sitting around, so what do? They sell their most liquid assets, US Treasury bonds. When hedge funds dump Treasury bonds, the price of bonds falls. When the price falls, the yield rises. The 10-year Treasury yield, which has been hovering at 4.2%, suddenly spikes to 4.5%. This triggers stop losses on other bond positions across the system. Pension funds, insurance companies, foreign central banks, they all start selling. The bond market, the safest, most liquid market in the world, enters freefall. When Treasury yields spike, mortgage rates spike overnight. Corporate borrowing costs explode. The cost of capital for the entire US economy just went up while you were sleeping. Companies that were planning to refinance debt can't afford it anymore. Real estate deals collapse. The housing market, already teetering on the edge of recession, tips over. Banks holding long-duration bonds on their balance sheets start reporting massive losses. Remember Silicon Valley Bank? Remember how they blew up because they held bonds and rates rose? That same dynamic is now live across the entire banking system. Regional banks, mid-sized banks, even the giants are sitting on unrealized losses. If depositors panic, if they start pulling money, we get bank runs. The FDIC steps in, the Fed steps in, but the Fed is trapped because if they try to save the banks by cutting rates, they make inflation worse. And if they hold rates steady to fight inflation, the banks die. The stock market crashes next. The S&P 500, the NASDAQ. These indices aren't trading on fundamentals anymore. They're trading on liquidity. As long as cheap money flows into the system, stocks go up. But the carry trade is the source of that cheap money. When $4 trillion of leverage gets pulled out of the market, there is no bid. There is no floor. The NASDAQ, which is up 40% over the last year purely on AI hype, gives back 20% in a week. Apple, Microsoft, Nvidia, the Magnificent Seven, the most crowded trades in history, they collapse under the weight of liquidation pressure. Emerging markets implode simultaneously. Turkey, Brazil, Indonesia, they rely on yen-funded capital inflows to finance their deficits. When the trade unwinds, the capital reverses instantly. Money floods out, currencies collapse, bond markets implode. We get 1997 Asian financial crisis, but this time it's global. And commodities flash crash as leveraged funds liquidate everything to meet margin calls. Gold, oil, silver, they all dump. Then, after the liquidation is over, after the weak hands are shaken out, the price of real assets explodes. Because the very act of liquidating the carry trade exposes the insolvency of the fiat system. So why would Japan do this? Why detonate a bomb they helped build? 3 theories are circulating. Theory 1, desperation. The weak yen is destroying Japan domestically. Inflation is crushing the middle class. Elections are coming. They're choosing domestic stability over global stability, even if it crashes the world. Theory 2, coordination. Japan didn't act alone. They acted with U.S. permission. Think about it. The U.S. has $36 trillion in debt. Interest payments over $1 trillion a year. The only escape is devaluation, inflation. But you can't announce that. You need a crisis, a scapegoat. What if Japan's move is the match that lights the fire? What if the Fed is waiting for the crash to justify massive QE, a return to zero rates? Theory 3, retaliation. Japan has been a U.S. vassal state since World War II, but the world is changing. China rising, BRICS rising, dollar dominance under attack. What if Japan is done subsidizing the empire? If they stop funding the carry trade, stop buying treasuries, dump their holdings, the U.S. loses its biggest foreign creditor. Treasury market collapses, dollar collapses, financial nuclear war, and Japan just put their finger on the button. I don't know which theory is correct, maybe all 3, but the data screams the $4 trillion carry trade is under existential threat. Market isn't priced for this. VIX at 14, complacency, bond market calm. Stocks near all-time highs, nobody hedging. Sleepwalking into liquidation that makes 2008 look like dress rehearsal. In 2008, it was subprime mortgages, one asset class. This time, it's the foundation of global liquidity, the $4 trillion engine that funds everything. When that seizes, nothing is safe. Let me show you the math. If the yen strengthens 10%, you lose 10% on $4 trillion, $400 billion in losses. These positions are leveraged 5 to 1. A 10% loss means 50% loss on equity. Margin call. Liquidation. Your liquidation pushes yen higher, triggering the next margin call. Doom loop. The yen won't move just 10%. If panic sets in, it could move 20 or 30% in weeks. In 1998, during long-term capital management, the yen moved 25% in 2 months, with a fraction of today's leverage. If we get a repeat with $4 trillion at risk, losses scale exponentially. Selling begets selling. Volatility begets volatility. Credit spreads blow out. Liquidity dries up. System freezes. Clearinghouses can't handle volume. Counterparties default. Systemic event. Who's holding the bag? Japanese banks, Mitsubishi, Mizuho, dollar assets funded with yen liabilities. Balance sheets implode if yen strengthens. European banks, Deutsche, UBS, US hedge funds, Bridgewater, Citadel. All short yen. It worked 15 years. Pension funds like CalPERS allocate to these strategies. If they blow up, retirees get crushed. If the carry trade unwinds, who bails it out? In 2008, Fed printed money and bought toxic assets. System survived, but dollar lost purchasing power. Can they do it again? Technically, yes. Fed has infinite dollars, but inflation is at 4%. If they cut rates and print to save banks, they lose credibility. Dollar tanks. Inflation hits 8, 10, 12%. Stagflation, currency crisis, Fed trapped. Save the system or save the dollar. Can't do both. The geopolitical angle. China is watching. They hold $3 trillion in reserves, mostly treasuries. If Japan crashes treasury market, China dumps holdings. Rotate to gold, commodities, yuan assets. Accelerate de-dollarization. Russia benefits, BRICS benefit. The dollar system that dominated since Bretton Woods is cracking. Cracks becoming chasms. Real assets, gold, silver, oil, land, commodities, things that can't be printed. Gold is at 2,600, silver at 71. If the carry trade unwinds and Fed prints to prevent collapse, these prices look cheap. The bailout validates that currency is worthless. Hard assets are real money. Smart money is already rotating. Sovereign wealth funds, billionaires, central banks outside the dollar system are buying. They see what's coming. Central banks buying gold at record levels. Not because it's a good investment, because they're preparing for the end of the dollar era. Japan's move is the first domino. The Bank of Japan told the world, we're done subsidizing your Ponzi scheme. Done being lender of last resort. You're on your own. Market hasn't figured it out yet. Still trading like 2019, like central banks have infinite power, like liquidity will always be there. But liquidity is confidence. Confidence is fragile. Once it breaks, once the herd realizes the carry trade is dead, the stampede is instant. Here's what I'm watching over 72 hours. The yen. If USD JPY breaks 155, short squeeze confirmed. Liquidation mode, treasury yields. If 10-year spikes above 4.5, bond panic. Fed forced to intervene. Bank stocks. If JP Morgan, BofA, Wells sell off, market pricing credit losses. Volatility. If VIX breaks 20, risk off. Above 30, crisis, gold. If it breaks 2,700, smart money fleeing to safety. Endgame started. I'm not saying markets crash tomorrow. These things unfold in stages, bounces, relief rallies. Central banks will issue statements, promise support. Market might stabilize, but the $4 trillion leverage bomb doesn't go away. It sits there ticking. Every time Japan signals they're serious about defending the yen, every intervention, the fuse gets shorter. Eventually it reaches zero. When the carry trade unwinds in full, market won't have time to react. Vertical move. Gap down. Liquidation faster than circuit breakers can stop. Here's the message. The global financial system is built on leverage, on borrowed money, on the assumption rates stay low forever and central banks always print. Japan shattered that assumption. They fired the warning shot. If you're not paying attention, if you're not positioned, you'll be caught on the wrong side of the greatest wealth transfer in history. People who hold real assets, gold, silver, land, commodities, preserve purchasing power. People who hold paper, stocks, bonds, cash in the bank, watch wealth evaporate. Not because dollar goes to zero, but because it loses purchasing power. Fed prints to save the system. Every dollar they print dilutes every dollar you hold. This is not a prediction. This is a warning. The Bank of Japan set in motion events that cannot be stopped. The $4 trillion carry trade is the foundation of global liquidity. That foundation is cracking. Smart money knows this. They're buying gold, buying real assets, quietly exiting paper markets, not waiting for CNBC to confirm, and not waiting for the Fed to admit it. They're acting now while there's still time. The window is closing, the fuse is burning. When the bomb goes off, there won't be a second chance to prepare.